Many thanks for joining across the UK, Europe, Middle East, and Asia. And it's a pleasure to have on the webinar today Emma Hernandez, Senior Mortgage Consultant at International Property Finance Group. Welcome, Emma.
Thanks, Grant. Good to be here.
Yeah, nice to see you again. How are you?
Very well, thank you. Yeah, enjoying some sunshine at last in the UK.
Yes, finally, looks like summer's arrived in the UK, which is good. It's long overdue. So welcome everyone. Delighted to host you onto this webinar today. So let's get into the first slide if we can, Marika. Okay, so what are we going to discuss today? We are going to discuss developments in the international mortgage sector. We're certainly at an interesting time now. We're on the cusp of certainly one or two interest rate changes. The ECB are meeting today where there might be a first rate cut in the Eurozone, which is obviously a significant market. Obviously UK interest rates are due to cut as the year progresses. So it's an interesting time to have Emma on and get her thoughts on mortgage rates and obviously the proposition of LPFG. I'm then going to lead in to talk about the advantages of using leveraging in terms of the benefits of magnifying your return through using the bank's money rather than just your own. And then we're going to use some case studies, historical case index for our previous investments through IP Global. And then we're going to talk about an opportunity that we have and how we see that performing going forward with using that leveraging. So let's get into the next slide, please, Marika. So I'm just going to talk about the IP Global business model for a second, and just sort of taking a step back from that, a little bit about myself. I've been with IP Global since 2006, coming up to 18 years, predominantly across Hong Kong and Singapore. And now I'm based here in the UK. Been back in the UK for about 2 years now and trip out to Hong Kong and Singapore during the course of the year for clients and meetings, etc. So no doubt I will see more of you as the year progresses. A little bit of background to the business model. So we are a business that has a global reach of 15 international cities and have invested in 18 countries across the globe. We have a tremendous amount of experience. We've actually transacted on over $3.5 billion of property investment. We have offices across the globe, across the Middle East, Asia, South Africa, and here in the UK, and a big business in China. And it's very much a transparent business. We consistently outperform our projections year on year. We actually co-invest with our clients. We actually commit our own capital. Before we do that, we do a tremendous amount of research and due diligence, and we provide all of that information in our reporting on our various opportunities. So what we provide, clients can check, double check our information. We provide comparable data on all of our projects, and we provide financial spreadsheets, etc., so that we can give clients as much information as possible so that they can make an informed decision. So we do a lot of research and due diligence at the outset for the opportunities we present, and then basically we manage the buying process from end to end to make it as simple as possible. So that involves introduction to a lawyer, assistance on the mortgaging side, which obviously we're going to talk about today with Emma and the good work that she does on the client side, helping clients through that important step of mortgaging. And then we do all the lettings and management as well. So across the UK, we manage, for example, 6,000 individual properties for our investors from a rental perspective. That's everything from sourcing tenants, dealing with any day-to-day issues, sending monthly statements, and ongoing management for as long as that client will require the assistance. So that's a little bit on the business model. So if we get into the next slide, please, Marika. Okay, so at this point, I'm just going to hand over to Emma. So Emma, over to you.
Thanks, Grant. Pleasure to introduce you to international property finance today, along with a little bit about the mortgage market and how we can assist with the financial element of your UK property investment as well. So who are we? International Property Finance, we operate in the Middle East and in the United Kingdom, and that's specifically with the purpose of providing a financial service to clients worldwide. Our specialism is providing personalised lending solutions for expatriates and foreign investors as well. And we've had many years' experience combined as a team. So we develop a full understanding of various jurisdictions where our clients live, where they earn income, so that we can best serve them as far as applying for finance, really. So this experience allows us to handle complex and simple property purchases and refinances, and deal with this effectively as well. We've got a great support team in the background too. So the UK is our core market, although there are other markets that we deal with as well. We are directly authorised by the main financial regulatory body and organisation in the UK, Financial Conduct Authority. And this gives us access to unlimited lenders in the UK, including those offering specialised lending, commercial, private wealth banks, as well as the mainstream banks as well that you'd see every day in publicity. So our focus essentially is to source the best lending solutions for our clients, for expatriates, foreign nationals, and we develop and maintain relationships with banks in order to do this really, and best facilitate arrangements for our clients. We work alongside banks as well. Very often we're asked to soft launch new banks because of our niche place in this market and our experience with it. We do collaborate as well in better ways to serve clients, different types of finance structures, things like that. Really, something else actually good to mention is other parts of the world. We often ask lenders to consider adding countries to their list of acceptable places for applicants to reside, with a level of success to open up options across the market there. Our goal really is to understand each of our clients' individual financial needs, build a long-term relationship, so we're always there on hand to help them with their financial goals and financial success, really. And that's our ethos, to put the clients first and achieve what they need to achieve as far as financial aspect goes. Are you okay
and just
to
on that,
move on?
Emma, I know that definitely, LPFG, they really do go the extra mile to help clients, and that's really, really important. It can be a tough business mortgaging, and as I say, the support infrastructure you have is certainly appreciated by clients.
Oh, that's good to know. Yeah, we do handhold as much or as little as possible, really, not just on the finance side, but actually after the mortgage offer's been secured and to completion. Help along the way, every step.
Yeah.
Take pride in that.
Yeah.
Yeah. Okay, are we all right to move on to the next slide, please, Marathon? Okay, so a little bit of information about the mortgage market at the moment. It's very buoyant. The property market in the UK, incredibly buoyant. We've seen a notable increase in mortgage lenders entering the market for international clients, banks are recognising there's a need there. And they're certainly coming up with new ways to help and support international investors. So there's more and more competitive products available and more lenders. They're becoming quite creative with the types of deal structure as well in order to better support their customers, which is great, really. Taking advantage of new technological advances as well, AI, things like that, ID checks to streamline the process. So it's a really exciting time to be involved in it, actually, because we're seeing many changes and progressive deals coming through.
And that's interesting to know, actually, Emma, because obviously, yeah, it can be a long process, and there's reasons for that because of the structure. But you're saying that AI is getting more involved and is kind of helping to speed up that process somewhat. Yeah.
It can do, yeah, cuts down on things like certification, things like that, just the logistics of putting an application through. Yeah, certainly.
Yeah.
As far as kind of what we're seeing from lenders, their margins are being squeezed, and they're trying to remain competitive with rates. We've certainly seen that, which only benefits our clients because they can access some really, really great deals at the moment, good mortgage options. There are rising demands for expats and foreign nationals for both purchases and remortgages as well. And we're seeing more deals coming through with free legals on remortgages, things like that, to help clients. So that's really good. Additionally, they seem to be branching out and diversifying with the types of buy-to-let deal that's coming through. Houses of multiple occupation, multi-unit blocks, social housing, things like that, short-term lets as well, Airbnbs, things like that are coming through. So it's certainly a growing market there.
So aside from basically interest rates, sort of, likely to change, the fact of you're saying there's more and more lenders coming into the market, which is going to make the rates actually more attractive, Emma. Yeah.
Indeed. Yeah. Lots of competition then.
Yeah. And on the slide here, you've got about swap rates. So swap rates, they're obviously the sort of rates that lenders buy into. I know they've kind of ebbed and flowed this year, but is generally the trend down? And this is kind of ahead of any Bank of England rate cuts. Yeah.
Yeah. There was a plunge in January, which we all saw in swap rates.
Yeah.
There's a little bit of a misconception really as far as what swap rates do. It's not actually based on the Bank of England base rate. And we've got the next review on the 20th of this month, I believe. But instead, it's more, they're based on a projection that lenders apply to what will happen to rates in future and the cost of passing that borrowing on to the client. So swap rates, as I say, they did plunge in January, but they stabilised, minor adjustments over the last few months. I foresee, my thoughts are, and I know a lot of analysts are thinking the same thing, that they will reduce over the next few years as well and come down a little bit.
Yeah. No, I would definitely agree with that. Obviously, inflation's come off from 10% plus a year ago to under 3% now. So definitely the trajectory seems that it's coming down. Obviously, there's an election at the moment, so whether they'll do it in June or August is irrelevant. It's going to happen, right? Interest rates are going to come down during this year, which is going to feed even more activity into the mortgage market, more lenders, more competitive rates, so on.
Yeah. I agree. Yeah, in discussions with lots of banks, they're all working on the premise that the Bank of England base rate will drop as well, which of course impacts tracker rates. So that's good to know that they're working on that basis too. Yeah. A little bit more information about the housing market as well. What we're finding is that shortage, supply and demand issue is still there. That there is a shortage of suitable housing in the market. So that's driving rates downwards as well because the housing market is so stable and the demand is there for both tenants and owner occupiers, which is a good thing.
Yeah, I think that's a really good point that you make. And obviously, we're talking about probably 160,000 homes again going to be built only this year against a target of 300,000. So I think that's a very good point there in terms of it gives lenders comfort to lend because, undersupply versus demand is healthy for the property market. Yeah.
Absolutely. Yeah. Are we okay to move on to the next slide, please? Sorry about that. Someone at the door in the background. All right. Yeah, the next slide, are we on that? I'm sorry, I can't actually see the...
Yeah, it's the one, what is available to clients is on with the various rate options.
Perfect, good. Yeah, lovely. So obviously we've discussed fixed rates that remain stable for a short period of time, 2 to 5 years. They seem to be the most popular at the moment with our clients because of stability and because they are very competitive in comparison to different types of rates. I think the next the rate to discuss is standard variable rate. So each lender sets their own profit margin. So there is great range in standard variable rates at the moment on where they foresee the market being. The discounted rate is actually a discount from that SVR. So that one will vary in line with what the lender believes will happen in the market and their own profit margins themselves. The other option is a tracker rate, which of course follows the Bank of England base rate and one to watch, considering we think that rate will reduce. So that's the different types of products that are available to the international market. As far as loan to value goes, at the moment, we're seeing a comfortable position for the vast majority of lenders is somewhere between 60 to 70% loan to value at the moment. What dictates that loan amount is a variety of factors, including the property itself, the customer's situation, and also key thing is the rental yield at the moment. Each lender has their own affordability calculation, which impacts how much can be borrowed. But although lenders will go up to 75% leverage, we're finding somewhere around the 60 to 70% mark is the comfortable position to be for a client. On to the next slide. So I won't read all these out. This is a kind of a scary list when you look at it. So this is kind of typical documentation that's asked for lenders. They will need to support a full mortgage application. I think how a case is presented to a mortgage lender is just as important as what lender you choose and what rate and deal you choose, really. We try and provide a story to a lender about our client's individual situation to put them in the strongest position possible to successfully borrow. So we obviously obtain the information and the documentation that's needed from our clients so that a lender can really know their customer as well and understand their customer too. Moving on to the next slide. So there's a variety of different types of finances, and I thought I'd kind of focus on just a couple really of key ones. Refinance is a big thing at the moment. So anyone with a portfolio or one property in the UK at the moment is pretty key because any equity in that property can of course be used to support growing their portfolio. A recent client of mine had one property in London that they had about £30,000 gross per annum. He refinanced that in order to purchase 3 other properties and doubled his income, his gross income and return from his property portfolio. So that can be an absolute key route for clients to grow their wealth. An overlooked one and one that kind of a lot of clients are averse to looking at is bridging finance, but it certainly has its place, especially with updating their current property or bridging a gap in order to grow wealth, property improvements, things like that, in order to create a larger income. So there's certainly a broader spectrum of finance that we can look at for our clients as well. Hope that helps.
No, that's very good, Emma. Can I just ask, just in terms of structuring, how do you find people typically structure an investment now? Do they mainly use like a company setup, for example, given the tax benefits there? What are you finding in the market right now?
Yeah, it does depend on a client's profile and their situation and their personal needs, which route works. But there is a massive amount of clients that are going the limited company route, especially if they're intending to have quite a large portfolio. That can work out very tax efficient in the long run on a number of levels. So yeah, most clients now are taking the limited company routes, especially for properties number 2, 3, 4. Yeah.
Okay. Yeah, no, that's good. That's good to know. That is good to know how people are structuring their investments. Okay. All right. So we'll move on to the next slide. I think that's me. Oh no, it's not. Sorry, Emma, you've got one more.
Oh, have I? Oh, yeah, absolutely. Sorry about that. So yeah, that was a little bit more about international property finance as a team. Our ethos is definitely client centric. It's client first, really looking after them and putting their financial needs first. And we have a few awards and accolades, but I think the biggest really is the fact that a lot of our clients recommend us. The vast majority of our business is actually by referral to friends and family. So just wanted to really mention, I take great pride in helping my clients and great joy as well. I really enjoy my job and what I do. It's there's no greater joy really than seeing a successful outcome for a client and working with them and really getting to know them long term.
Yeah, I think that's a very important point you make there. I think the personalised approach is certainly not a one cap fits all situation that you take there, and also it's not only that, but as you sort of touched on there, it's the variety of options that you have for investors, Emma, which really does help. And as I say, I'm not surprised you get the number of referrals you do, given the A1 service you provide. So I think so I think I'm on now from the next slide, Marika. We can move on. So thank you, Emma. Thank you for that. We're going to come back. There's no doubt there's going to be a number of questions. So I will just kind of actually build on from that to the point where we're just going to talk a little bit about the advantages of leveraging versus just purely buying in cash. So this is actually quite a nice, simple example. If you look here, if you was to invest $125,000 US dollars in a tracker fund, let's say that grows by 5%, well, your 5% of 125,000 is 6,250 US dollars. So your investment will have risen to 131,250. Now, let's say you wanted to invest 125,000 into a property. Well, actually, you can leverage. So in effect, you can borrow the bank's money alongside your money. Let's say typically up to 75%. So your 125,000 US dollars can become part of an investment that is actually 500,000. So you could be looking at a property for 500,000 US dollars by investing your 125,000. So in effect, what you have now is if your investment grows at 5%, like the tracker fund, you're not getting 5% on the 125, you're getting 5% on the 500,000. So 5% of 500,000 is 25,000 US dollars. So you can see immediately the impact of leveraging, using your money and the bank's money to magnify your return. So 25,000 on a leveraged investment versus 6,250 on an unleveraged investment. So that is quite a simple example to show you the benefit of using the bank's money, mortgaging, leveraging. So in effect, your investment is now worth 150,000 US dollars versus 131,000 on an unleveraged investment. So a difference of 19,000 US dollars odd in just over a year or so. So that's that's it in a nutshell, basically. Why the benefits of using leveraging. So let's go into a little bit more about that. Let's have a look at the impact on some of our projects actually over the years in terms of how leveraging has magnified those returns. So if we can go into the next slide, please, Marika. So here's a nice appraisal going back to 2010. So before I go into that, I think it's important to not only mention that leveraging magnifies the return, but it's also the quality of the projects and the locations and the ethos of investing. And our ethos, as I mentioned, is we co-invest, we put our own capital in. So we do a tremendous amount of research and due diligence on the areas that we see opportunity to property invest on behalf of our clients. And the ethos of the business is looking at value spots, areas where we're not too early in a business case, we're not too late, we're at that midpoint, there's regeneration, new transport infrastructure, etc., etc. So these type of projects really sort of summarize those main points. So if you go across here, you've got Art House, which is in Hackney. This goes back to 2010 when people were questioning why we're investing in locations like this, where they're a little bit rough around the edges. But basically, we identified great opportunities where it was a little bit cheaper to rent and buy, but new transport infrastructure was coming, new regeneration, etc. Similar to, for example, Spa Road in Bermondsey. Again, a similar type location as Hackney about 14 years ago. Then obviously, if you look at some of the other ones in London, the old schoolhouse in North London, again, a pocket of value that we could see an investment case arising. And if you look at those three, Art House, Spa Road, and Old Schoolhouse, you will see the unleveraged return, and then the leverage return, the fact of the magnification of that return by using the bank's money alongside your money. And then as we move across from there, we have the projects, the Assembly, Woburn Wharf, the Curve, Trafford, One Trafford, and Arc Avenue. So these are projects in Manchester, Birmingham, and Newcastle. If you look at the Newcastle project, that won a series of awards back in 2022, UK Property Awards, refurbishment, conversion of the year. Great location, great developer. And then if you look at the Assembly, that was featured on a Netflix series this year. And we were getting in there at the time of the whole sort of Northern Powerhouse story, the de-risking of London, the regeneration of the north of England, the better transport infrastructure, new commercial hubs, regeneration, transport, etc. And that's really blended through into these fantastic returns on a leveraged basis. And then in most recent times, if you look at the Curve, One Trafford and Arc Avenue, they all have an evolving investment case right now. The Curve, of course, you have HS2 going into Birmingham over the next few years, and that is a massive infrastructure that's going on, with the fast train link being 42 minutes into London and all the associated infrastructure alongside that. One Trafford is close to the centre of Manchester, close to Manchester United Stadium as well, where the Ineos Group took over Manchester United Football Club, and there's a whole series of regeneration going on there. And then, as I mentioned, Arc Avenue in Newcastle, again, early days for the project, but a lot of money and wealth being created in Newcastle, obviously following the takeover of Newcastle United and the Middle Eastern investment associated with that. So this kind of does explain the advantage of using that leveraging on the yellow box there versus the unleveraged on the blue box, but also it's critical that you're investing in a location with a very good underlying investment story. Next slide, please, Marika. All right, so we're just going to talk at the end here now just on a past investment and a new investment and how we see that playing out. So in simple terms, what we have going on here is the Assembly, which is a project we invested in 2016, and it's explaining where we are now or thereabouts in sort of Jan 24, Jan 25, the property value and how that has grown. And this is an example of where, in effect, you put in 30% as your capital, you've leveraged at 70%. So in effect, with your 30% deposits, you've put in around about £66,000. And actually, what we're seeing is plotting sort of a price from 220 to 279, so around about sort of 59,000 property appreciation there. And in effect, when we look at the return on equity after a 10-year period, we're tracking around about £89,107, about a 97% return on investment there. Now, there's a few other things going on here. Not only have you got the capital appreciation side, and obviously the advantage of the leveraging, but you've also got the fantastic income stream where you're tracking a yield of about 5%. So if you look on the bottom there, your estimated net rental income would be about £120,000. And Manchester rents across the UK and the city centres are super strong. Again, it's because of this very critical undersupply. We used to talk about there might be 20 inquiries for one property. Now we're talking about 35 inquiries for one sort of rental property. So there's more and more people looking to rent, and there's less and less stock in the market because over the last few years, inflationary pressures, build costs, slow planning rules, developers putting off building during the fact of interest rates going up has meant that we are more and more of a supply crunch, and this is really going to create an exciting time for investors going forward, because you can't just turn on supply like a tap. It's going to take many years. We're talking about only ended up on 160,000 properties this year, as I mentioned, against a backdrop of 300,000 a year needed. And if you throw in the undersupply that's going to be on the board over the next few years versus this pent-up demand where people have put off buying in a high interest rate environment, as rates start to come down, this big pressure of people coming into the market to buy, hitting this wall of undersupply is going to be very, very positive for property investors. So again, the opportunity here is once you've come to the end of this investment cycle. So if we look at the sort of growth we're talking about now, it enables the investor to refinance, to take this profit out and to put it on to a new investment property, and then start that whole process again. Put 30% down, borrow 70%, invest in the right location, of course, and then to track the capital appreciation, and then a number of years afterwards, repeat the process again. And alongside that, obviously, you'll get a good, strong yield in these city centre type locations. So it's very good to share how an investment has turned out. And as I say, the Assembly is an excellent location in the centre of Manchester. All right, so let's move on to the final slide. So this is a project in York. This is our York opportunity that completes at the end of July. Fantastic location, great developer, the Helmsley Group. Our second project with this developer. Again, if you look at the ethos we've had from the successful projects in London and Manchester I shared earlier, and the Assembly, we see this one tracking exactly the same trajectory going forward. If you read recent reports, you'll see that York is a real hotspot in terms of growth. Only this week we were talking about the fact that rents are up about 13% in York over the last year. Incredible numbers. This is all to do with this significant undersupply in the city, and also about all of the exciting regeneration that's going on over the next 5 to 10 years, about £1 billion worth of regeneration. But it is critically undersupplied as a city. There was a real shortage, particularly of 1 and 2 bedroom apartments, and it is a beautiful city. Anyone who hasn't been there, I'd definitely put it on your list. Also 2 Russell Group universities there. So again, everything what we're looking for: regeneration, undersupply, growth of population. It has everything in a tried and tested IP Global investment. So we're looking here on the basis of, if you're putting 40% down, we're tracking over a 10-year period, roundabout a return on equity of about £64,000, which would represent a 69% return on the investment. And of course, as we've stated, along the bottom there, not only are we talking about the return on equity, but also the very attractive rental income return, estimated rental income over this period, 92,264. And as I say, the rental market is just going to get stronger and stronger. as time progresses, on the basis of this critical undersupply that we see, particularly in cities like York. And if you bear in mind again that if you look at interest rates, I mean, we're talking here about, we've mentioned here about a 7% interest rate. You know, that doesn't detract at all from the fact that leveraging magnifies your return regardless of the interest rate, and the fact that, of course, rents are very, very strong on the other side, though. But we are just about to enter, I think, a really exciting period for investors where rates will start to come down. Interest in terms of rental market is going to remain super strong because of the market being critically undersupplied. And as I say, we're looking to end up on about 160,000 properties built in the UK by the end of this year, against this backdrop of 300,000 needed to be built. So in other words, you're talking about very, very consistent long-term yields, interest rates coming down, lots of pent-up demand because we've seen less buyers last year through interest rate hikes. We have to acknowledge that. But we're going to go through a period where into the second half of this year and into the first quarter of next year, we're going to see rate cuts, and we're going to see lots of people come back into the market, and that sentiment really start to change. So now is a perfect time to position yourself into the market, to buy, wait, be patient, hold, and then ride that capital appreciation wave and strong rental market that you'll see alongside that. Okay, we've come to the end of the webinar. We like to try and keep these short and sharp, but we've got a couple of questions that we can go through. So actually, Emma, there's a couple here for you. I know you touched on some of this information earlier, but there's one here. What are the prepayment penalties, and how do they affect borrowers who wish to pay off their mortgages early?
Okay, so prepayment penalties, early repayment charges are usually applied when you're in a fixed deal with a lender, or a period of time that you're in a deal. They usually work on a percentage of the loan amount that's outstanding, and if you settle the loan in full during that period, then those penalties would be applied. However, a lot of lenders will allow overpayments during that period within certain parameters. Typical amount is 10% of the outstanding balance per year, so that you still can chip away at that capital and reduce it, reduce the amount of interest you're paying, and certainly make savings by using that facility.
Yeah, okay, great. How does international property finance differentiate itself from other mortgage providers in the competitive market for expat and foreign investor mortgages? Well, I can answer the first part. I mean, it's definitely the personal service, but do you want to add anything else to that?
What was the second part of the question, Grant?
How does IPFG itself differentiate itself from other mortgage providers in the competitive market for expat and foreign investor mortgages?
Okay. Yeah, as well as the personal touch, we actually really focus on maintaining and developing relationships with banks in order to better serve our clients as well. So we will actively go out and find different types of funding, different types of deals, open up criteria to accept a larger audience. And also, because we are very niche, very specific for the international market, we've got the leeway to do that. And very often we have banks approach us. We are trying to access this market. Will you soft launch with us? So we've got those links and those relationships in order to better serve our clients, really.
Okay, great. Here's another one. In today's market, what is more advantageous, a fixed rate or a variable rate?
At the moment, cheaper definitely is fixed, because of that stability for a cost-effective mortgage over a 2 or 5 year period.
Okay. What else do we have here? There's actually quite a number. What are the benefits and drawbacks of shorter versus longer amortization periods?
Mm. The drawback would be the budget, so the monthly payments, paying off that capital over a shorter period is obviously higher. But definitely a benefit to paying it off shorter is the less interest that's paid overall. It does depend on a client situation, but generally, if they do want to pay it off very quickly, the lump sums very quickly, I do suggest sometimes, depending on that budget, to allow themselves some comfort every month to perhaps have a longer period mortgage term, but then use that overpayment facility to cut it down and make lump sum payments to shorten it and reduce their overall costs. But it is very, very client dependent.
Right, that's very good advice. Obviously, personalised to the individual's circumstances, basically. Yeah, and getting a grip of those. Okay, I suppose it's one sort of fairly direct question here. I've got an 8% mortgage. Can you help me get a better rate?
Yes, very likely. Yes, definitely. There are some really competitive deals for international clients out there at the moment. So if they're paying 8%, they're overpaying.
Yeah, I think on a serious note, I've come across that quite a lot. I think there's a lot of people, particularly outside of the UK, who are passively paying some of these rates and perhaps not even realizing it. So, I'd urge everyone to kind of review what sort of interest rates they're currently paying, because I do know from experience, Emma, that you've been able to help a number of my clients paying, these type of interest rates. So it's actually a good question that should prompt everyone to have a conversation with Emma to check what their rates are and to have a real serious mortgage appraisal. Yeah.
Definitely.
Okay, I'm just conscious of time. I know we're running up to sort of 45 minutes or so. We like to keep these to under the hour. So I think there's one more question here. Actually, this one for me. What are the best markets to invest in and why? Well, it's actually quite a broad question. I think I would basically, as I sort of intimated earlier, I think it's all about the cycle we're about to go into. If you go back 18 months, we would have seen 15 rate rises in the UK, US, interest rates going up, Eurozone rates going up. We're now on the cusp of another cycle, which is effectively a likely downward cycle of rates, obviously starting maybe today with the ECB cutting their rates at their meeting, and then the UK and US in tandem, potentially the UK before the US because inflation coming off quicker. And as I say, the fact is that will change sentiment. And also, as I say, it's really about the fact that that's going to bring a lot more people into the market for buying. And as I say, there is real serious limited stock in the market, which has culminated in these inflationary high interest rate cycles we've seen over the last sort of 2 years or so. So I think it's very much about doing your research and due diligence, but effectively, as I say, it's the cycle that's key now. It is a perfect cycle to get back into property investment, to buy, to wait, to hold, to be patient, and ride the growth that we expect over the next 6 to 12 to 18 months as interest rates start to come off, more people invest, and they're hit by this wall of undersupply that is there. All right, so I think that's about it for now. Emma, do you have any sort of closing comments, thoughts you'd like to add?
Yeah, just to get in touch if there's any questions or queries. Happy to provide some answers, some simple answers, or have a full consult. It's absolutely fine. And just thank everyone for attending and listening.
Yeah, no, thank you, Emma. I think you've provided a really good overview there, particularly of the service proposition, the types of mortgages available, what you're seeing in the market, the way people structure their investment in terms of buying through, for example, the company structure. And certainly it makes sense to people to reach out to you on that side if they'd like to review, particularly, as I say, when you reflect on the person who dropped a line about paying 8%. I'm sure there's a lot of people paying high rates that can be reviewed at the moment, which can then be addressed, you can look at refinancing options, looking at obviously buying into other properties. On my side, look, hopefully that's giving you an idea of the fact of the benefits of leveraging, simply using your money and the bank's money to magnify your return, and the real strong benefits of that, and how you can make really strong investments through using the bank's money with your money. In terms of opportunities, if you would like to receive any further information on what we've covered today, do drop me a line. I can pass on the details to Emma, of course, or from the mortgaging perspective. If you require any further information, for example, here on the Marlow House opportunity, I'd be delighted to help you. But yeah, hopefully what that's done today is give you a good sense of the mortgaging market out there right now, and also, as I say, how leveraging can play a very key part in your property investment. So all that remains for me today is thank you for attending. I hope that's been insightful for you all. Thank you, Emma, for your invaluable input, and look forward to speaking to you all again very soon. Thank you very much indeed.
Bye-bye.